Financial markets refer broadly to any marketplace where the trading of securities occurs, including the stock market, bond market, forex market, and derivatives market, among others. These markets are vital to the smooth operation of capitalist economies and may include assets and securities that are either listed on regulated exchanges or else trade over the counter. The selling or buying of financial assets takes place between two parties, buyer and seller. When financial markets fail, economic disruption including recession and unemployment can follow. Owing to its significance, it is essential to have at least a basic understanding of financial markets. Therefore, in this course, you will learn about the different types of financial markets like bond market, commodity market, forex market, stock market, derivative market, and cryptocurrency market. Stay tuned for more details.
If you haven't subscribed to our channel yet, I want to request you to hit the subscribe button and turn on the notifications bell so that you don't miss out on any new updates or video releases from Great Learning. If you enjoyed this video, show us some love and like this video. Knowledge increases by sharing, so make sure you share this video with your friends and colleagues. Make sure to comment on the video with any queries or suggestions and I will respond to your comments.
So before moving on, let's talk about our learning objectives. So we'll start off by knowing what exactly are financial markets, what is the need of financial markets, and also why are financial markets important. Then we'll know about the various types of financial markets. We'll start off by knowing what is a stock market, what is a bond market, what are currency exchange, what is a commodity market, what is a cryptocurrency market that is in hype these days. And also we'll be talking about the most riskiest part of the market called the derivative market. So we'll start off by knowing what exactly are financial markets. So we can consider financial markets as a marketplace or a bazaar, right? We go to various supermarkets. A supermarket has various components, like we have groceries, we have vegetables, we have fruits, we have various cleaning items, and all of this is in particular one place, right? But similar to this, we have financial markets. So all the equities, bonds, securities, currencies are traded at one particular place called the financial markets. So basically how you buy a particular product in a grocery store or something like that, in a financial market, you exchange money. Money is exchanging hands and it is circulated from one individual to the other or one individual to an organization. Now, selling or buying of financial assets takes place between two major parties. One is called the buyer, the second is called the seller. So we start off by knowing what are the different types of financial markets. So we can assume a financial market as a house. And there are various key elements to that house. The first one is called the stock market. The second is called a cryptocurrency market. The third is called a forex market, which we often refer to as foreign exchange. Then it is derivative market and also commodity market. Various livestock, various agricultural products are traded on commodity markets. So we'll next know about what exactly is a stock market. So stock market is a place where shares of publicly traded companies are bought and sold. So the buying and selling leads to a fluctuation in prices. It can be on the positive side, it can be on the negative side. Now, the companies are registered at this particular place called exchanges. We'll know about that going forward, where people buy and sell. So in India, we have two major exchanges called the National Stock Exchange or NSE or the Bombay Stock Exchange or BSE. So there's a very good history of how the stock market came into picture. So it was around the year 1600s. So the world was not explored much at that time. The maps were not drawn at that time. So in order to explore the world, the ships were sent out from the harbors to various parts of the world. So in order to maintain these ships, it was a very heavy cost that used to come up. So the companies individually cannot have all the money put in for the ships to go across the world. So in that case, they thought that we'll take the money from various common people so that they can explore the world and also incur and take care of the expenses that have been incurred. So what was that for a common man? How would a common man gain profit out of it? So in that case, they thought that when these ships go and find new places, all the treasury, all the gold that they find, they will distribute that among the people who gave them the money in the first place. So this is how stock market came into picture. Now the investors purchase these shares and allow the company to raise money to grow its business. Now, every company in order to grow needs a capital expenditure. We call it capex. So so these capex is required to enhance the company to take it forward for them to move forward. So the stock market does come with a lot of risk, but with the right investment strategies, it can be done safely with minimum risk. So what used to happen currently in the digital world is that everything is on just a click of a button. So we can buy, sell all the shares with a click of a button. But in the 1900s, it used to be physically. So if you were living in the places where Bombay Stock Exchange was there or National Stock Exchange were there, only then you can physically go out and hand out the slips, right, of buy and purchase of the shares. But now in this era, we can do it just with a click of a button. So we'll understand what exactly is a share. Now we can consider a share as a small part of ownership in a financial asset or a business entity. So for example, you are a company and you plan to raise 50 lakhs, right? So you divide those 50 lakhs into small chunks of shares with a small value and distribute it among the people. Let's take an example. As we can see that a company called X, Y, and Z, right? Let's take an example, a company X, Y, and Z. So now it needs to raise a sum of around 50 lakhs. So in order to do that, what it can do is distribute those 50 lakhs into 5 lakh shares with 10 rupees per share. This is not a fixed value. It depends on the company, what they want to do. They can also make it as, let's say, so the company don't always need to have 10 rupee as 10 rupee per share. They can also distribute it as, let's say, 50 lakh into 1 rupee per share. 1 rupee per share. They can also do that. Now, what happens is that the company divides its total capital into small chunks called the shares, which is used to raise money again. But majority of these shares are kept with the promoters of the company or the top brass of the business. The reason is that the main decision making body is the board, right? So they need to have majority of the shares so that they can have control over the particular entity. So this is why minority of the shares are let out in stock exchanges for common man or the retail investors to purchase. Next come is what exactly is a stock exchange. Now you may have heard a lot of times these words stock exchange come into picture, right? So what exactly is a stock exchange? We can consider it as a building or maybe a mall in which different types of companies are registered there, are kept there for the common man or the retail investors to purchase. So in India, stock exchanges are a very big part of it. There are two stock exchanges called the National Stock Exchange or the Bombay Stock Exchange. So in National Stock Exchange, around 1700 companies are registered. And in Bombay Stock Exchange, almost 5400 companies are registered. Now, in order to know the growth of the India, basically to know the growth of how these companies are doing, we have different indices, which is for National Stock Exchange, it is called Nifty, which comprises of 50 of the top companies, and their growth can be measured looking at how they are performing on day-to-day basis. While on the other hand, Bombay Stock Exchange has its index called as Sensex, which comprises of top 30 companies, and you can also know what type of growth is happening by looking at their graphs. So next we'll talk about how does the stock market work? What is the theory behind it? How does the prices fluctuate? How as you retail investors can invest your money? So in general, the main governing body of stock market is called as SEBI, which is called Security and Exchange Board of India. So that regulates the entire markets. How do the markets perform? What is the thought process behind each company registering itself, and if there are not any malpractices that are happening. So if you want to invest in a company XYZ, right? You cannot just go right there and ask that, okay, give me XYZ number of shares. You need to go through a entity called as stockbrokers. So these are the people who have registered accounts in the exchanges. These are the people who know how the markets work. They are the people who have the right to invest in a particular company by your money. So they have the right to do so. So we as retail investors, right, we have to make, apart from our saving banks account, we have a savings bank account, right, that we all use, right? Apart from it, we need to open one more account which is called as a demat account. So demat account is the particular place in which you can trade into securities. We call it securities or equity markets. So you need to open a demat account. Now demat account will have a particular account attached to it called as a trading account. So all of your buying and selling will happen in your trading account, and through this trading account, whatever the loss that you incur, whatever the profit you gain, will be transferred to your demat account. Now this trading account is linked to your broker's account. So when you ever trade in any particular company or any particular stock, these brokers will pass on your order to that particular company in the exchange, and they will give you a confirmation that yes, your particular order is complete, and then you will receive it in T plus 2 days. So India follows a T plus 2 day settlement period. So if you buy today, after 2 days you will receive that particular stock in your demat account. So the brokers are just the medium. So your stocks are stored in an entity called CDSL, which is Central Depository Securities Limited, or NSDL. So these are the two things. They are government owned, and they're the companies in which your stocks are stored. Next, we talk about what exactly is a bond market. Now, bond market is also known as a fixed income market. Now, this type of markets are not very volatile. These are safe entities, right? This is also called as a safe investors heaven. So bond markets, you usually don't have a lot of fluctuations in prices, and also they are considered as a loan to a government, company, organizations by the people. So we lend out our money to these organizations or government so that they can give us an interest on the payment, right? So governments and business entities, they issue bonds to raise capital. Now, what is this capital needed for? For example, if a company wants to establish another business in another country, so for that, massive amount of capital is required. Now, most of the companies don't have that kind of money, and if they go to the banks and ask them the money, they would probably reject their own loan requirement, stating that it is too high for them to give it. So in that case, what these companies do, they roll out bonds, which guarantees the particular investor or the people that when you are giving, like let's say 10,000 rupees, you will get additional 10% interest in next 4 years or 5 years. So this is how the bond entity works. Now investors who buy these bonds get regular fixed payments for a specified duration, right? It is similar to what we call as a fixed deposit that you and I, everyone would know that how it works. It's similar to that. Now bond market is less volatile, as I already mentioned, than the stock market. There are still certain concerns about the bond market that I will be talking about. So there are essentially three types of bonds that exist. Number one is called the government bond. Second is called the corporate bond, and the third are the less known ones called the municipal bonds. So what exactly happens? Repeat. So what exactly happened in the government bond? So the federal government issued the government bonds to raise the money for various developments that might be happening, like let's say big infrastructure. You need to make express highways, you need to make large complexes, you need to make bridges, you need to lay down the railway line. So all these things require massive amount of capital, so these government issue bonds. There can be one more reason that I would not be taking up into deep consideration, that is to reduce the liquidity in the market. Now, just in case of how COVID happened, a lot of money was printed by the government and set out in the system, repeat, in the cash system of India. So what this leads to rise in inflation prices. Inflation is at its all-time high. So to reduce this kind of inflations, also government use to roll out bonds so that they can reduce the liquidity in the market. Now second is that these bonds attract a lot of investors, right? Government bond, because it is a central government that gives out these bonds, so the risk of default, risk of them not paying you back, is very less. And the other reason for issuing government bonds is to minimize liquidity, as I already mentioned. And also these bonds act as a sovereign bond. We also call it sovereign bond depending on which country or which you are in. India you would call it as a government bond. In America you would call it as a sovereign bond. So it depends on a lot of areas as well from where you belong. But also these bonds are the most safest type of investment considered. They don't generally have a lot of interest rates. They would probably give you a maximum of around 6% of interest on your investments. But since it is safe, so you are guaranteed that 6% you will receive it at the end. Next comes is corporate bonds. Now corporate bonds are issued by big business entities or small business entities to expand their operational activities throughout the world. Now they are there's a term which is used, is called as capex, which is called capital expenditure. So they need to make a proper plan where they are investing the money that they are getting after issuing those bonds. So corporate bonds are usually very long-term instruments, and so their maturity comes from 1 year to, let's say, 5 years. So there are two types of corporate bonds. One that are issued by very big organizations like, let's say, Reliance or Tata, that are more trusted ones, right? You will be more than happy to give your money in exchange of an extra interest. But also then there are some companies that are not very known. They are small capital companies, and they also roll out their bonds. So what would happen is that they would have a higher risk of defaulting. So the first type is called as investment grade bonds. So investment grade bonds are very high quality bonds and are more oftenly for fundamentally strong companies, as I mentioned, like Reliance or Tata. And they also have a lower risk of defaults, but also lower interest rate. So their interest rate would be very less, let's say 4 to 6% at max. So this would be an interest rate of a corporate bond of a big company. Second, we call it a high yield or junk bonds. Now these are issued by relatively less known companies, and their risk of default is very high. They could probably run away with your money if they want. And this is a very high risk type of investment, but also since it is a very high risk, so you also get high rewards out of it. So their interest rate would be somewhat between 7 to 10% at max. So these types of investments are called as a junk bonds or high yield bonds. Next is called municipal bonds. Now municipal bonds are generally considered as a tax saving option or a tax saving bond, because you are not liable to pay any taxes on these types of bonds. But they are less common because they are not easily rolled out, because it's more of a municipal thing, more of a locality thing. So if a small government owned entities want to open a park, let's say, build a park, build a statue, build a flagpole or something, and they need investments for that, then they issue these kinds of bonds, which have a very less, they have a very less interest rate. They are not very attractive. So, but they are also a stable investment to put your money in. The investments would, the interest rate would probably be around 2%, but still it is considered a very common type or more stable type of investment. So next we'll talk about what exactly are Forex market. So Forex market stands basically trading of currencies, right? We always see in news that there are always news about $1 is equal to how much rupees. The dollar has taken a dive. The dollar has increased against INR, Indian rupees. So all these things, how do they come to know what is the fluctuations that are happening? So that all is done through Forex market. Forex market involves buying of one currency and selling of another currency, and it involves buying and selling of currencies. So the profits are booked by buying and selling and predicting the direction in which these currencies are likely to take in future. So it is not necessary that today you buy the currency and you can predict it right now. You can also take a bet on next 2 to 3 months. We call it futures. So you can also take a bet on the future price and trade it today itself. So the forex trading gives a very high rate of interest, but it also comes at a very higher risk. You can lose all of your money at once as well, and you can also gain a lot of money at once. The forex market has two major components called the interbank market and the over the counter market. Now in interbank market, what exactly happens is that large banks trade currencies for their balance sheet adjustment. Now these banks are basically investment banks or big banks like Goldman Sachs or JP Morgan, Morgan Stanley. So all these banks, they use to trade currencies for the adjustments in their balance sheet, right? They need to make their balance sheets good, so that the investors look at in a very positive way and they don't look at the negatives of it. And the second part is over the counter market, which is for you and me, like retail investors. You can trade in those currencies through brokers and online platforms. Online, some of the banks have their online platform, or general any companies that are in the brokerage firm, they can also do these things. So the forex markets are predominantly divided into three major parts. One is called the spot forex market. The second is called a forward forex market, and the third is called a future forex market. So we'll take a deep look into each one of it. So the first one is called a spot forex market. Now the spot forex market is an immediate exchange of currencies between the buyers and the sellers at a current exchange rate. So whatever is happening throughout the day, that will start in the morning and end in the afternoon. So it does not have a leap over into 2, 3, or 4 days. It's the current day, the current scenario. And most of the trades, right, their deliverables are in that particular day itself. It is not prolonged to next week or long. Most of the trades in spot markets are by bank, dealers, speculators, and brokers. So all the major trades in the spot markets are done by major investment banks, major dealers, major brokers, and most of the individual and retail investors stay away from the spot type of markets. So big investment banks, as I already mentioned, make up the large part of spot forex trades. Next comes is forward forex market. So in forward forex market, what exactly happens is that two parties agree to trade the currency for a fixed price in future. So it is not today, not tomorrow. So it is basically 1 or 2 months in advance. So they can actually speculate whether the currency will go down, whether the currency will go up. So they take a bet at a number that is in future, right? So now this involves a lot of risk, as I already mentioned. If you don't meet up to the exact price that you are putting your money in, you may end up losing a large chunk of money. That is exponential loss, right? So the next is the two parties can be either governments, individuals, or companies. It is open to all, and they are generally not heavily traded. Hence, they are not liquid. So the volumes of trades in these type of forward markets is less because it is on a very high risk level. Next comes this future forex market. So they are similar to the forward market, but in in future forex market, it is mostly traded in centralized trading markets like in NSE, BSE, or you can actually make your account on these brokers and you can trade it yourself. They are highly liquid because since it is on the centralized trading markets, it does not involve an agreement between the two parties. Therefore, so it has more volumes and hence highly liquid. So commodity markets, the first question that comes to our brain is what exactly are these commodities? Now, commodities is mainly natural resources that can be mined, or they can be commodities like agricultural products or livestock. So what exactly happens is that we bet on various energy, spices, or crude industry. So according to how much volumes that are being extracted, for example, how much gold is extracted, or what are the oil prices that are currently circulating within the world, we take a bet on these prices and we invest in this. So if we think that the prices will go high in the coming future, we'll buy that particular commodity so that it will have a greater gains for us. So basically the commodity markets are divided into two major categories called the soft commodities and the hard commodities. So hard commodities are natural resources that are mined, right? It requires physical digging of a particular land to extract it. So these are like rare earth metals like gold, silver, or it is aluminium, nickel, or oil that is extracted by it's a complex process to dig out these things. So that is called as hard commodities. Then comes the soft commodities. Now soft commodities include agricultural products, livestock, like agricultural products like paddy, wheat, coffee, cotton, you name it. Most of the things that are directly grown on land, there probably comes under a commodity market. And also livestock like pork. So all these commodities are also traded like forex currencies. So they have spot, futures, and forwards. Similarly, commodities also have spot, forex, and forwards. So these commodity markets are not a new thing. So around in 1600s as well, they used to happen most of the trades through barter system. So these commodities were traded in exchange of spices, or any other things were exchanged for that matter, and they were also forward market then. So if you are failed to pay a particular price for that particular commodity, you will be probably giving out the things that you grow in the coming future. So this is not a new concept. The commodity market started way back around 200 years ago. So this existed back then also. So next we'll talk about what exactly are cryptocurrencies. So this is the most hyped up type of markets that we all know. All the millennials and everyone who are in their 20s know about these markets because of the hype it has gained over the past decade. Now, cryptocurrencies are a sort of digital currency which is decentralized in nature. So you don't have any intermediary governing institute to look after it. There are no regulations in cryptocurrencies, which is why it is considered diversified type of cryptocurrency markets. Now, every transaction that ever exists is on an open ledger, right, which is accessible to anyone. So what would happen is that in a centralized organization, if it is governing a particular thing, so most of the things you and I would not be aware about. So that is the case why cryptocurrencies were born. So what happened in the 2007 or 2008 market crash? So at that time, all the banks, they gave out bad loans. We call it the housing bubble, right? Most of the banks gave out bad loans to people, and they could not repay the loans. Hence, most of the investors who had the money just in their banks lost a lot of money, right? So in that case, there was a pseudonymous person called Satoshi Nakamoto who discovered Bitcoin, right? He wrote in an academic paper that the currencies should be decentralized in nature and everyone should know what exactly is happening. So every transaction that is made in a cryptocurrency world is on a public ledger which is accessible to everyone. Now, these cryptocurrencies, they work with a particular technology called the blockchain technology. Now, so every transaction that is taking place is almost impossible to change and hard to fake. So which is why it becomes more trusted with people like you and me, that everything is decentralized in nature, everything is open, it is transparent, and so not within one particular organization. Now, cryptocurrencies, they guarantee the value of transparency, hence it is more trusted by you and I. Next is derivative market. Next, we'll talk about derivative market. Now, the derivative markets are a very high volatile markets in which you have instruments called the forwards, futures, and options. Now, these are based on an underlying asset or value. For example, if you have a major stock, let's say Reliance stock or a Tata stock, so it would have a very large value that most of us wouldn't be able to afford, right? So they have a certain section called an underlying asset. So it's like a small kit to that parent company, which you can invest in quite cheap money, right? But that would not be of a particular day or a particular time. It would be in a future, in a forward instrument, in about 2 or 3 months ahead of time. Now, these instruments you can invest your money in, but they are very volatile. Like, they can give you exponential losses as well as exponential gains. So I would not deep dive into what exactly are derivative market because it is out of the scope of this particular course. But I will tell you that they are highly leveraged elements and they have a very high risk potential. They are again of three major types called the forward contract, the future contracts, and the options contract. Okay, so let's look at what we have learned so far. So we have learned what exactly are financial markets, why are markets important. Then we learned about what exactly is stock market, how does the stock market work. Then we discussed about the different types of bonds and the bond market, like the government bonds, corporate bonds, municipal bonds, and also looked at what exactly are derivative markets. Then, so we also learned the way in which the currency is traded, what are the different methods in which the currency is traded. And at the end, we also discuss about the commodity markets and also the cryptocurrency markets, which are in higher uptrend and are the more hyped about. In the end, we discussed about what are commodity markets and also what are cryptocurrency markets. Why are cryptocurrencies so hyped up market? What is the benefit of cryptocurrencies? And also, why does cryptocurrency have such high influence on the young generation these days? So all these things we learned in this course. I hope you had a very knowledgeable session. For more such videos, stay tuned to Great Learning.
If you haven't subscribed to our channel yet, I want to request you to hit the subscribe button and turn on the notifications bell so that you don't miss out on any new updates or video releases from Great Learning. If you enjoyed this video, show us some love and like this video. Knowledge increases by sharing, so make sure you share this video with your friends and colleagues. Make sure to comment on the video with any queries or suggestions and I will respond to your comments.